Here's how the wealthy make millions and pay zero in estate taxes. Step 1. They buy appreciated assets like real estate, stocks, and even life insurance. Step 2. Instead of selling, they borrow against those assets completely tax-free. Step 3. They put it all into a trust, so when they die, their heirs inherit everything without the estate taxes. No selling, no taxes, just generational wealth.
Let's break this down, because I think what's happening here is the conflation of a variety of different strategies that don't necessarily meld well together to accomplish what's being shared in this post. You see, going out and acquiring appreciating real estate is definitely a laudable goal on its face. That's something that should be considered by many if you're interested in creating real wealth. But what I will say is, if your goal is to do that and at the same time shield that asset and its future appreciation from estate taxation, well, there's some challenges that you need to be aware of. Because the only way to really accomplish that would be to shift the asset from your own personal ownership into an irrevocable trust. And doing so has ramifications. You see, item number 1 that you should be considering is the fact that doing that, meaning transferring the asset from yourself into the trust, means you no longer own that asset. It's now owned by the trust. And there can't even be any incidence of ownership, because it has to be truly separated from you in order to make that irrevocable trust actually functional. And if that happens, that means you don't get to personally enjoy that property or the fruits of the property, meaning the income it generates or the ability to borrow against it and use those borrowed dollars personally. All of those assets now are confined within that trust for the benefit of the beneficiaries of that trust, which would not be you in an irrevocable trust scenario. Now, another point of consideration is that trust would also be separate from you for tax purposes, meaning it would have to file its own tax return. And in fact, trusts are onerously taxed. Like, there's only 4 tax brackets, and they escalate to the highest tax bracket at relatively low income thresholds. So it would not necessarily be a great scenario for those who are actually trying to reduce their exposure to taxation in general. Third, we have to understand that when you gift that asset into the trust, along with that asset comes its basis, meaning at your passing in the future, there will be no step up in basis. The basis remains, so that your trustee in the future, if and when they ever sell that asset, there potentially could be a capital gain event if they sell the asset at a price greater than you acquired it at. So all of these things are things that need to be considered. Now, when you're trying to figure out which strategies make the most sense for you, given your own personal circumstances and your own individual goals and objectives, you really want to sit down with a professional that has a great handle on how all of these strategies actually work well together and which don't. So I have no idea whether or not I can add value in your situation, but what I do know is we can find out. All you need to do is drop the word apply, and let's see.